Mark Fields, the ex-CEO of Ford Motor, validates likely a $2,000 price tag for Tesla stock, is our story today. This is Greg for Tesla Fan Insight. Thanks once again for joining us. If this is your first time, welcome. Repeat visitor, welcome back. Wanted to thank our Patreon supporters as well as our subscribers. If you enjoy the show, please take time to like and subscribe. So, since Tesla's announcement on Thursday, there's been a lot of suggestions or question marks about whether or not that $1,200 price target is validated. Over the past few days, we've been trying to determine what's going to happen next, meaning that pretty much the analysts that cover Tesla stock have really targeted at the high end something like $1,200, maybe $1,250 in price, with a everything perfect sort of top end of possibly $2,000 a share in the near term. So the question mark is sort of what is going to happen here and why, and how do you think through it that makes sense? And so I've been doing a lot of reading to determine, kind of where we're at, because our analysis was, number one, you have a target price for the analysts sort of prior to earnings of about $1,200 on the high end, maybe $1,250. And so now that the stock price has gotten there, kind of where are we and where are we going from here? Is the stock going back down to sort of meet what analyst estimates are? Is the stock going to stay about the same because we've met the number? And the third option is, might it continue to rise? And sort of how do we find metrics to put around this that actually makes any kind of sense? And this is where the interview with Mr. Fields came in. So as you all know, Mark Fields is the ex-CEO of Ford. He was fired by the current chairman, I believe 2 years ago, and replaced with the former head of Steelcase. And then Ford has not been showing well since, but that's neither here nor there. The issue right now is that he's a partner at something called TPG, Texas Pacific Group, which is a large hedge fund, well, they do a lot of different things, but they're a private equity fund that manages large amounts of money on behalf of pension funds and other large investors in terms of investing those funds. So I've heard and seen him previously, but our real measure of large executives, auto executives responding to what Tesla's about, the general trend has been illustrated by Bob Lutz, in which they indicated that, hey, those guys are going to find a way to go out of business, is initially Bob Lutz's thesis. And of late, he's really shifted his perspective towards perhaps Tesla doing okay, especially if the per sale vehicle price point is at the levels it currently has, which is in the late 50s. So in comes Mr. Fields with a 5-minute interview, which is what I think is perhaps one of the best interviews on Tesla that I've seen ever, but definitely within the last 2 or 3 years. So the CNBC interviewer was really asking a question of, can we validate a $1,200 stock price for Tesla right now? And isn't that a little bit beyond what it should be in light of the fact that it now has a bigger market cap than Toyota? And Mr. Fields' comments, I thought, were really, really interesting. The first thing that he pointed out was that there's a problem right now. The problem is that the nearest sort of competitor to having large-scale product to respond to Tesla is actually VW and their IDE product, but they're having software issues with it. I would say that the software issues are probably related to battery, sort of battery management systems to make sure they optimize the range that they've guaranteed customers. But it hasn't been stated what they are. They're just having battery issues currently. And so he basically indicated that in light of them being the closest entity that might get something out that'd be competitive with Tesla, this basically suggests that, that might be a focal point of figuring out whether or not competitors can really come after Tesla currently. The second part of his argument, which was very brief, but we'd like to dive into further, is the fact that he indicated that despite COVID, the emission mandates in both Europe as well as China have not changed. And so this is very interesting. The mandates in Europe basically call for the manufacturers there to meet certain goals when it comes to emissions, especially if they're selling large and polluting SUVs. The result is those folks haven't been able to successfully build and sell large numbers of their EVs. And as a result, we now have a situation where Fiat, Chrysler, GM, and others are now having to pay Tesla EV credit money in lieu of actually building and selling enough cars to reduce their carbon footprint of their fleets. So this has actually become rather lucrative for Tesla currently. And Mr. Fields also highlights the fact that this money coming to Tesla is actually fairly large dollars. And one of the problems that he highlighted was that he felt that one of the challenges Tesla has coming on the horizon is the fact that the amount of money they're getting EV tax credits is being blended in to, in essence, increase the stated margins that Tesla is getting in terms of how much profit they're making. And so what he was suggesting is that it's great for Tesla now, but in the future, as other companies start doing their own manufacturing, it reduces the amount of money coming in Tesla in this fashion. So it potentially could be a threat to the success of the company going forward, given that their profit margins would decline because of the manner in which they're accounting this. Now, our analysis is that temporarily that number actually could go higher. And the reason is that there's some debate, at least the CEO of Daimler was talking about this, about the fact that there's a problem lurking, which is they're making vehicles that are EVs, but the nature of vehicles being made, the customers aren't buying them. So it's a question mark as to do the large OEMs get to count those sales or count the production of those vehicles if they're not being sold or if consumers don't want to buy them. And so it's an interesting question, but it basically suggests that Tesla's in good shape, at least for the next year or two, possibly 3 or 4. So I thought this was pretty solid in terms of analysis. Another element of how this analysis plays is that some statistics just came in that suggested that in May, there's a tripling of sales of Model 3s in China. And so this plays into his discussion of the non-relaxation of EV targets. And there's a debate going right now. How will China play out for Tesla? Will large Chinese manufacturers move in and suddenly start producing large numbers of EVs and selling them successfully, harming Tesla in the process, or vice versa? The early returns are that as Tesla is able to build more vehicles, the market share they're taking keeps rising. At this point, we're seeing 62% market share. The sort of underlying theme here is that there's a lot of faith by Chinese consumers in foreign manufacturers to deliver great products, service them well, etc. So despite there being a domestic EV industry in China that's growing, the problem is that the confidence in non-Chinese products remains strong, hence Tesla and other success in that space in China. So, what I'm kind of stunned by now is that the Model Y hasn't hit China hard yet. They've got a lot of orders, but it's been suggested that that vehicle is actually going to be way more successful than the Model 3. And so we were expecting Model 3s to kind of slow down. And the question is, well, why would they increase in value rather than slowing down? And I remind you of how the Chinese mandate works with electric vehicles, which is if you want to buy a new ICE vehicle, the waiting list to have an operating permit for it can take as long as 3 or 4 years plus large fines. No delay when it comes to EVs. There are other pressure point techniques used by the Chinese, including relaxation on certain taxes, etc. So their general idea is they want to transition. Another note in China is the fact that depending on the last number on your license plate, there are alternating days that you're allowed to drive. So particularly during COVID, as we have infection issues, etc., there are a large number of people that would rather not use public transportation, further mandating why it is that Tesla ends up with stronger sales. And the final sort of piece of this and puzzle for us when it comes to China is Elon's discussion of the fact that all the cost inputs in China are 1/2 the cost inputs experienced in America. So what this suggests is that Tesla is going to be able to find its way into the marketplace at a price point that makes it competitive with even domestic manufacturers of EVs in China. And when you add brand recognition, brand reputation, etc., you can see why Tesla ends up with huge market share and huge profitability in China. In fact, based on Mr. Fields' comments, it's our feeling that we're going to end up in a situation where Tesla is selling more in China than it is in the United States or Europe, and possibly both of them combined based on the size of the facility that's being built currently by Tesla. So we think this is pretty exciting news, and it kind of answers the question, where is Tesla going to get the sales to validate its current and future stock price? And the answer is the kind of growth that we're seeing going on right now in Europe and China, and then as this moves forward. I've been intrigued to watch because we're keeping an eye out for news that might pop up on what Tesla's doing in different places and how sales are going, etc. One of those circumstances that popped up is in Sweden. We were told by one of our viewers that currently you really can't get any new Teslas, only used are available because of what the demand is like, combined with the fact that production has been slowed/shut down coming out of the Fremont plant. So given that Europe and China are providing direct and indirect incentives that are pretty large in dollars to consumers, we would not be surprised to see the amount of EVs continue to grow, and Tesla's share of those EVs, the market share ends up being 70-80% plus. And sort of one of the other points that we identified that Mr. Fields didn't discuss is the fact that there's a goal that Tesla has over the next year, and in theory this will happen out of the battery day that's coming, where Tesla is actually eyeing getting to the point where you have parity in cost between electric and non-electric vehicles. And so as we move to that territory, the mandate for Tesla and potential where it goes market share wise, I think ends up being rather large. And this is really exciting news. One last footnote that comes to mind is that there are different ways in which different countries and the EU are working, but Tesla is currently operating, as you know, the plan is to bring the semi-truck to Europe, and it turns out that tractor trailers are not allowed to operate in many places on the weekends because of the noise and pollution, and Tesla has already begun applying for permission to operate 7 days a week because they're running silent/quiet electric in those cities and towns instead of high polluting and noisy vehicles that might affect people's ability to enjoy their weekends. So what all this suggests is we're lining up into a zone where Tesla's generating huge sales, and they're taking market share based on EV share, and they're also taking market share versus taking sales from ICE vehicles across the globe. And it looks like both China and Europe will end up being larger and more important markets for Tesla than the United States, because as you know, the tax credits expired here and have not been renewed, and they actually are going very strong in these other places. So all of this suggests then that as individuals who are analysts are having to pick through the numbers and determine if the current price is validated and then the future numbers will be validated for the company, I think the answer is a resounding yes, and I think it's pretty exciting for the stock holders like myself, and hopefully you as well. At any rate, thanks for the comments, Mr. Fields. Thanks for the comments that are in contrast to the Bob Lutz analysis of things. And we're excited to sort of see how this plays out in the stock market, because this looks like it really validates Tesla's stock price to go much higher based on all the parameters that I just described. At any rate, I want to thank you for joining us. Just a reminder, 25 leg lifts a day helps to maintain sort of leg and knee strength so you don't have issues there. Also wanted to encourage you to consider a 5-2 or other diet. 30 SPF or better might be good for sun protection from cancer, as well as perhaps 1 or 2 times a week weightlifting to strengthen. This is Greg for Tesla Fan Insight. Tschüss, macht's gut. German, au revoir, French, Lehitro, Hebrew, Choda Hafez, Farsi, Hey Do, Swedish, Zdravstvuyte, hello in Russian, Ni hao ma, hello in Chinese, Do widzenia, Polish, and in Jamaica we say enough respect, walk good. Thanks for joining us. Have a great day, and bye for now.